everyone, and welcome to the Adjusted for Risk podcast here from the shores of South Lake Tahoe. So, this week we received the August CPI report, which showed once again high inflation will remain stubborn and it's not going to go away without a battle, unfortunately. Inflation rose 0.1% for the month of August and 8.3% over the past year. Furthermore, core CPI, which removes the volatile food and energy prices, rose 0.6% in August and 6.3% over the year. So rising rent costs and food prices are going to continue to keep inflation elevated, which are some of the stickiest components of the CPI calculation. So it really doesn't bode well that inflation will decline meaningfully in the near term when those two components, rising rent costs or shelter costs and food prices, keep climbing, unfortunately. So the thought of inflation coming down without the economy slowing substantially was put to rest by this week's CPI report. Another reason inflation will remain stubborn is due to deglobalization, which really has been widely overlooked, I believe. Supply chains have been disrupted, and the thought of a new world order between China and Russia has really hindered globalization, which puts upward pressure on prices as companies can no longer now easily outsource parts of their manufacturing lines or outsource services to cheaper regions of the world. So when you have to rely on more expensive parts of the world in terms of labor, like the US, that's going to increase prices. So markets really tumbled following the CPI release, with the S&P fell 4.3%, its worst day since June of 2020. During the peak of the pandemic, while the Nasdaq fell over 5%. The disappointing inflation reading, along with some disappointing comments from FedEx regarding the health of the global economy, really pushed equities lower for the week. So it was a very tough week for equities based on those two data points. So after you really focus on the market reaction to the higher than expected inflation print, market participants are turning their attention to the Fed and how the central bank will react and how the position portfolios for a period of time that includes an extended period of high inflation and front-loaded hikes in interest rates. So following the August CPI release, many market analysts called for a 100 basis point hike from the Fed coming up here in their next FOMC meeting versus the expected 75 basis point hike that the Fed has been using during their past couple FOMC meetings. So I personally think the 100 basis point hike right now is too aggressive, and the Fed should continue to stick to their 75 basis point hike next week. And going along with that is the headlines from FedEx also makes it harder for the Fed to hike rates by 100 basis points, really as the global economy continues to slow. 100 basis points to me is just too much right now. I know it will go a long ways to inflation, but that would really hinder an already struggling global economy and US economy. I do believe we'll see the Fed funds rate at a range of 3.75% to 4% by year end, which is up from the current range of 2.25% to 2.5%. So based on that, the Fed still has a long ways to go by year end. But I think, with another 75 basis point hike here, we will get to that 3.75% to 4% range by year end. And that's going to be needed in order to help cool the economy and bring inflation down. Currently, markets are pricing in a Fed's fund rate of over 4% by this time next year in 2023, which would be the highest Fed funds rate since January of 2008. So when you look at it, how will 14-year high interest rates impact the economy and investments? I think that's the million-dollar question right now. The increasing expectations that the Fed will have to increase rates above 4% has impacted long-term inflation expectations as well. Currently, the 5-year inflation expectations have come down to roughly 2.6%. However, that march to 2.6% from our current levels of 8.3% is going to be a slow one. The only way inflation will reach that 2% is to substantially slow demand, which means the economy is going to have to suffer through some more pain. A soft landing is no longer a base case option any longer. Instead, I feel a base case is a shallow recession, which is what will be needed to get inflation near the Fed's 2% target. Now, equities will feel pressure moving forward. When you consider a recession that includes an increase in unemployment, is now the base case combined with a lower third quarter earnings forecast. The S&P 500 earnings estimates have been revised downward from $515 billion on June 30th to $485 billion currently. And that's roughly a 5.7% decline or revision in third quarter earnings. And also, according to FactSet, that 5.7% decline in earnings is much higher than your typical downward revisions during quarterly earnings. So this downward trend in estimates is going to continue too. We're still in the middle of this cycle, so look for downward revisions to continue. Furthermore, the forward PE ratio sits at just a little below 6.8%, 16.8%, which is really in line with the 10-year average of 17. And when you consider inflation is at nearly 40-year highs, a recession is likely, interest rates heading towards levels that we have not seen since 2008, and earnings forecasts continue to be downgraded. I think multiples that are in line with 10-year averages really seem high, and I think they should come down further. This is going to result in weakness in equities in the near term. And when I say near term, you're looking at 6 to 9 months with elevated volatility. So the question then turns to what considerations should be made when positioning a portfolio for an environment of higher interest rates, slowing but still elevated inflation, a looming recession, and equity volatility. So I think the first part is start with focusing on high quality names, high quality sectors, or industries where companies exhibit strong cash flow, solid balance sheets, and pay consistent dividends. Additionally, look for areas of the market that are able to withstand slowdowns in economic growth. The first place to look when you're looking for parts of the market that can withstand slowdowns is in more defensive parts of the equity market, like consumer staples, healthcare. And for more conservative investors, you may want to look into utilities. Furthermore, with inflation expectations remaining above the Fed's target 2%, through 2023 at least, combined with rising interest rates, look for the value style to outperform the growth style. While US equities continue to face headwinds in terms of higher inflation, higher interest rates, slowing US economy, I still favor US equities over international equities. When you compare the two, international equities face much stiffer headwinds caused by the ongoing war in Ukraine, looming energy crisis due to that ongoing war in Ukraine, and hawkish central banks that are likely to slow economic growth in their fight to tame inflation. The European Central Bank, the ECB, has a very tough task in their hands when they are trying to fight inflation by raising interest rates. But on the other hand, they have very difficult economic situation that, due to a looming energy crisis, that makes their job very difficult. So while the US is staring at a shallow recession, Europe is facing the prospect of a deeper recession due to the obstacles they face. Meanwhile, equity volatility is going to remain elevated as central banks around the globe tighten monetary policies and reduce liquidity. This volatility will provide opportunities for long-term investors with higher risk tolerances to gain or increase exposure to stocks or sectors that are traditionally expensive, like information technology and consumer discretionary sectors. For investors that can handle the volatility and the rough seas ahead and have longer time frames, this could be a good opportunity, a good buying opportunity for those investors. And lastly, put an emphasis on capital preservation while increasing portfolio diversification. And that makes sure it aligns with your client's investment objectives. It's rough seas ahead, a lot of volatility. So you want to make sure you preserve your client's capital. So when markets do turn, they are able to capture more of that upside. Then as for fixed income, which is a really interesting play here, 10-year treasury yields are above 3.4% for really the first time since they were consistently above this level during the first 10 years of the 2000s. So it's been well over 10 years that we've seen 10-year yields at this level. And with inflation remaining sticky and the Fed remaining steadfast in its battle against inflation, I do not believe 10-year yields will reach 4%, despite higher inflation and higher interest rates. I think the big dynamic here that's going to keep 10-year yields below 4% is that investors have been starved for income for the better part of the past decade. Soon investors, particularly foreign investors, will see treasuries trading at an attractive yield, north of 3.5%, which will prompt them to start buying treasuries, which will put a ceiling on yields. When you think it wasn't, for the past 5 to 8 years, treasuries have been, 3%, less than 3%, 3.5% for these income-starved investors is looking very attractive right now. So you're going to start seeing flows go into treasuries. That's going to put a ceiling on those yields. I think similar to equities, continue to focus on high-quality bonds. Additionally, look to floating rate bonds to help hedge against rising interest rates. As for the riskier high yield bonds, I think it's still a little too early there. The yield spread on high yield bonds sits at 4.7% or so, and it's just not at attractive levels right now and well below levels that indicate financial stress ahead, which is quite interesting. So the reward for high yield bonds just does not offset the potential risk at this level to make them a compelling case, or make a compelling case for high yield bonds. So with that, I think high yield bonds, that riskier play, it's still a little too early. So with that, you can find more of my thoughts on inflation and how to position portfolios moving forward in this new market or investment regime, this macro backdrop, which is very difficult for investors. But with that, make sure you stick to your investment objectives, stay true to your investment goals. Don't take big wagers one way or another, because that's when you can really set yourself behind. So with that, thank you very much. I hope you guys have a great rest of your week. And to get more of my insights, you can catch my more insights at A Wealth of Insight from 6,237 feet.com. You can also catch the rest of our podcast, which we have some great guests on in previous podcasts, at Adjusted for Risk YouTube channel. And you can also catch the audio version at Spotify or Apple Radio, wherever you catch your other podcasts. So with that, thank you very much for listening, and have a great rest of your week.